Hey, what's up investors? Welcome back to the channel. My name's Cole, and as always, we have another exciting video today, one that has the potential to change your financial future. Today, we're going to be talking about the 5 secrets to becoming a successful investor. Whether you're a beginner investor or an experienced investor, this video will provide you with valuable insight on how to navigate the complex market of investments. So let's dive right in. Before we jump into the specifics, let's understand what it means to be a successful investor. Now, oftentimes, this is going to be subjective to the individual because investors have different purposes for why they invest. Some investors like to preserve their wealth, some investors tend to grow their wealth, and other investors like passive income like dividends. Now, nonetheless, becoming a successful investor or being a successful investor can be judged off making smart decisions consistently, managing risk effectively, and being able to achieve your goals over time. So now let's dive into the specifics. One last thing before we get started, if you guys could subscribe and hit the like button, it would really help support the channel and get this out to more people. The first step to becoming a successful investor is to clearly define your financial goals. You need to ask yourself, what is the purpose of me investing? What do I want to achieve with my investments? By knowing this, you're going to allow yourself to make better financial decisions and better investment decisions and allocate your portfolio accordingly. Now, whether this is saving for a down payment on a house, maybe for retirement, or maybe even your children's education, knowing this is very important. I recommend using the framework SMART. This stands for specific, measurable, attainable, relevant, and time-bound when making your goal. This would sound something like, I'm saving for a down payment on a house. I need $50,000 over the course of 5 years. The more specific, the greater likelihood that you will achieve your goals and hold yourself accountable. Step 2, educate yourself. Knowledge is the foundation of successful investing. Now, I want you to take the time to learn about different investment vehicles, such as stocks, bonds, ETFs, mutual funds, and even real estate. I also want you to take a look at different investment strategies, such as passive, active, growth, value, dividend, just to find out what works for you and what doesn't. Now, you can do this by reading books, articles, watching YouTube videos, following people that provide valuable financial insight. And now, it doesn't matter how you do it and consume this information, but the important part is that you start. Step 3, diversify your portfolio. Now, diversification is an important concept that many investors subscribe to, and what this means is to spread your investments across many different asset classes. Now, this could be a mix of stocks and bonds, ETFs and real estate. This is just to reduce your overall exposure to one area. What's this going to do? It's going to help you reduce your risk and maximize your potential returns. So basically what it means is not having all your eggs in one basket. You want to spread it out. So if that one specific stock or that one specific real estate piece goes down 30%, your whole portfolio doesn't go down with it.
Step 4, invest consistently. Consistency is a key factor when it comes to being a successful investor. So make it a habit to invest regularly, regardless of market conditions. By practicing dollar cost average, you can capitalize on market fluctuations and lowering your average cost over time. If we look at some of the best investors of all time, including Warren Buffett, Peter Lynch, or Charlie Munger, something you can tie together between all 3 of them, which is very rare. One common trait is consistency. They were all consistent. Now, if you're an investor who says, oh, the market's up 30%, my portfolio is overvalued, so I'm going to sell it all now and pull all my money out of the market, and in 3 months when the market dips, I'm going to put it all back in and make so much money. This is very difficult to do, and what you're trying to do is predict the market. Now I'm going to share with you a stat, and I hope it changes the way you invest and see the stock market. Over the last 30 years, if you have been investing this whole time, and you had missed just the best 10 days, meaning if your money was pulled out of the market for just the best 10 days over a 30-year period, your overall returns would be down 50%. So by missing 10 trading days, you cut your overall returns in half over 30 years. So I hope that makes you rethink the way you invest. Step 5, keep emotions separate. When it comes to investing, it's really important that you keep emotions out of the equation. Emotions cloud your judgment and trick you into making irrational decisions based off fear or greed, which are 2 factors that drive the market. By taking a long-term perspective and avoiding short-term market fluctuations and making impulse decisions, you're going to be a lot better off. By focusing on your goals, being consistent, and making the right informed decisions based off facts or data, you're going to get better results. In summary of the 5 topics we talked about in today's video, which included setting financial goals, educating yourself, diversification, investing consistently, and emotions, if you implement everything I talked about into your investing style, you're going to find a lot more success as an investor. Now, if you found this video helpful, hit the like button and subscribe to the channel to show some support. If you're interested in joining a Canadian investor group chat or following me on other socials, then the link will be in the description. And as always, stay savvy, investors.